So it feels like every year the media and all the short-term fortune tellers try to predict a market crash happening that same year. And if it doesn't happen that year, they push their predictions out to the following year. And when it doesn't happen then, they push it to the next year. And when it doesn't happen then, they push it. Well, you get the idea. And given that we're now progressing through the second half of 2019, I'm starting to see all of these fortune tellers push their predictions out into 2020. Now, as you guys know, I'm a long-term investor, so I'm someone who believes that a market crash is not something to be feared. I actually think that it's a blessing that should be taken advantage of. But we're only humans, so I suppose it's natural to wonder when the next market crash will happen, either because you're afraid of it or because you're just very eager to take advantage of it, kind of like myself. Now, don't ask me to give you guys a prediction on when the next market crash will be, because I have no idea when it'll happen, and anybody who claims to know is straight up lying to you. We really have no idea when the next market crash will be. But if you're wondering what are some of the factors that could potentially increase the chances of a market crash happening in 2020 or sometime soon, then stay tuned, because I'm going to give you 5 reasons or maybe causes for a market crash potentially happening in 2020 or again sometime soon. But anyway, I hope you guys enjoy this video. Make sure you hit the like button if you do. Really helps the channel survive and grow, and it really means a lot to me. But with all of that said, let's go ahead and get started. What's up everyone, my name is Ale and welcome back to my world of stocks. Now there's obviously a number of factors that could cause a market crash, including a war, terrorist attacks, natural disasters, and so on. But to keep this video a little more focused or concise, we're just going to focus on what could potentially cause the next United States recession in 2020, as that would obviously lead to a lot of stock market panic and probably a decent crash as well. Okay, starting off with reason number 5. This is the one that I actually care the least about myself and that I think is the least important, to be honest. But the funny thing is that it's the one that is used the most by the media and the general public. I always hear people say this, and it is that we've just gone too long without a recession, so we have to have one. Now, we're also going to cover in this reason, we'll cover something that is a little more serious, which is technical indicators like the inverted yield curve that point to a looming recession happening sometime soon, and that is a little more serious, to be fair. Now, if we look at a historical chart of recessions for the past 100 years, separated by 10 years at a time, we can see that it's extremely rare to go more than a decade without having a recession in the United States. And while it is difficult to argue with history, this isn't a reason that I take very seriously myself, because it doesn't take into account how much our economics have changed over time that are ultimately extending the time periods of our economic expansions. For example, I created this chart here for you guys to show you the longest economic expansions since World War II, and you can see that the one leading up to the dot-com bubble burst of 2001 was previously our longest expansion. That is until our most current expansion that we're going through right now, which as of this July 2019 hit a record-breaking 121 months of expansion. Of course, it's a scary thought to go this long without a recession, but assuming that one will happen next year just because it's overdue might be a little bit of a stretch. As an old adage goes, economic expansions do not die of old age. However, anyone that is trying to make that prediction will likely point to specific signals or indicators that have throughout history warned us about a looming recession happening sometime soon. Take for example the inverted yield curve, particularly the 10-year minus the 3-month, that has accurately signaled a recession in each of the past 7 recessions. This happens when bond investors predict that the US economy will weaken in the future, which would mean that the Fed has to lower rates to stimulate the economy back up, and so investors are trying to lock in higher rates right now for longer term bonds like the 10-year treasury. And that ultimately drives up the price of the bond and lowers the yield. Meanwhile, short-term bonds like the 3-month end up having a higher yield than the 10-year, and an inversion is therefore created. This is what leads to the panic of a recession occurring typically within half a year to as much as 2 years after the inversion. And we already saw an inversion take place at the end of March, but it only lasted for a few days, which wasn't enough to take seriously given that most economic models require the inversion to last about a quarter for it to be used properly. We have, however, seen this inversion take place again for the past month or so, but more recently it's been climbing back up to neutral, so it's something that we just need to keep an eye on. In any case, the inverted yield curve is much more of a serious issue than just simply saying that we've gone too long without a recession. But When speaking about more serious issues, that leads us to reason number 4, which is going to be the entire trade war between the United States and China, which is something that is constantly talked about in the media and in just kind of the general public too when discussing the macroeconomic conditions of the country and the looming recession. And the reason why this one is such a big deal is because it is essentially a global conflict between the two biggest economies in the entire world. And the other issue is that there's just a lot of uncertainty surrounding all of it because we constantly go through a lot of ups and downs. Sometimes we think that a trade deal is going to get done very soon, and other times we think that there is like no hope in sight. And because of that, we're ultimately left with all of this uncertainty, which is something that you don't really want to have when talking about a looming recession happening sometime soon. Now, as of last year, the US imported $540 billion worth of goods from China, while they only imported $120 billion, leading to a trade deficit of almost $420 billion. This enormous deficit, coupled with intellectual property theft by China, led to the US slapping tariffs of up to 25% on $250 billion worth of Chinese goods until a better deal is negotiated. On top of that, US President Trump was going to add those tariffs to the remaining $300 billion worth of goods, but later changed his mind at the G20 summit, where the two countries agreed to a sort of ceasefire on any new tariffs. Meanwhile, China, on the other hand, has applied tariffs to almost all US imports at around $110 billion worth of goods, but their tariffs range from 5% to 25% depending on the product category. At the G20 summit, Chinese President Xi also agreed to purchase more farming products from the United States while they reopened trade negotiations. However, just as quickly as things were turning positive, they are once again turning a bit sour, with new reports claiming that China's imports of US farm goods have actually declined since the summit, while the deficit has increased by 11%, which doesn't really look like progress, especially for the United States. And it can certainly be argued that China is having an even more difficult time, as they've just hit a new 27-year low for their GDP annual growth rate at just 6.2% for the second quarter of this year. And if we zoom out a bit, we can see that this growth has been in a downward trend for the past decade, and again, this is the lowest it's been since the early 90s. Still, there are many conflicting reports about the current state of progress. On one hand, Trump needs a deal to help boost his re-election campaign in 2020, while China needs a deal to prevent all the companies that are leaving China in favor of ones that are not tariffed. But on the other hand, several reports often note that the ruling Chinese Communist Party is in no hurry to make a deal, as all they really need to do is wait out President Trump, since they don't really have to worry about presidential elections in their country. And there's also reports of them emphasizing a nationalistic pride message of China versus the United States across much of their media to get the public support during the trade war. And obviously here in the United States, politics is a very polarizing subject right now, so there is definitely a lot of people who do not want to support President Trump and the entire trade war. I'm not going to share my opinion on that because this isn't a political channel, but what this ultimately keeps coming back to is the whole issue of uncertainty, because we just really don't know what's going to happen. Now, if I'm forced to make a prediction, and I've made this prediction in the past, it's that I think a trade deal does get done. I think both countries make some compromises so that both presidents can claim some public victory. But I think it's a trade deal that is a little bit in smaller scale than people are expecting. And I think it'll be renegotiated little by little in the future as well. But in terms of what's going to happen right now in the end of 2019 and into 2020, we just really don't have all the answers. But if everything goes horribly wrong with the whole trade war with China, and you also add on to it other global macroeconomic issues, then you could definitely have a higher risk of recession in 2020. But what are those other global macroeconomic issues? Well, that leads us to reason number 3, which is other global macroeconomic issues. Okay, so the first thing that comes to mind here is Brexit, which is Britain leaving the European Union, which could have a major impact on the way they handle free trade between participating countries. Now, there could potentially be a cancellation, a trade deal exit, or a no deal exit, and depending on what exactly happens, many analysts think that the UK could potentially go into a recession as a result. And as the 5th largest economy in the world and one of the biggest trading partners of Europe, this could spill over into the rest of Europe's economies and even lead to a global recession in the worst possible outcome, which would obviously impact the United States as well. Now, they've already delayed the deadline for a decision a couple of times because it's been very difficult to agree on a final exit strategy, but currently the next deadline is set for October 31st of this year. And if Brexit actually goes through, then an implementation period through the end of 2020 will be given to allow the markets and businesses to adjust, so we may not see the real negative impacts until the following year. However, Europe is already dealing with major issues of their own, given that the eighth largest economy in Italy just went through a recession of their own as defined by 2 straight quarters of negative growth. The fourth largest economy in Germany got about as close as you can get to a recession with 1 quarter of negative growth and the next one being flat before recovering a bit after. And on top of all of that, you have widespread debt issues throughout the entire continent, like Greece owning hundreds of billions of euros to the European Union all the way through 2060, which was loaned out to them just to keep them from going under. And speaking of debt, that leads me to reasons number 2 and number 1, which are probably the 2 reasons that I'm the most concerned about myself. And coming in at reason number 2, that's going to be the current debt levels of the United States. Now, when tracking US debt levels, one of my favorite websites to use is usdebtclock.org, and I'm going to shift here to a still screenshot so that I can easily highlight the areas that I mentioned. But you can see here that the US national debt has already surpassed $22.5 trillion, which is more than double what it was just a decade ago, and on average, each US citizen carries over $68,000 of debt, which balloons all the way up to $180,000 per taxpayer. And if you think that's bad, keep in mind that we spend over $4.4 trillion a year, yet our federal taxes only bring in around $3.4 trillion, leaving us with a deficit of over $1 trillion a year. Not a great sight when Medicare and Social Security alone cost us more than half of our budget, and those are 2 things that are extremely hard to get rid of, given that 10,000 new baby boomers qualify for retirement every single day, which is double the amount that we had back in 2000, leaving us with one heck of a funding problem. And it's very difficult to fund these things when you have all of this debt dragging being a drag on the economy and on people as well. Not to mention that recent pushes for free healthcare and wiping college debt with free tuition in the future could add even more costs to the bill. Don't get me wrong, college debt is a huge problem at over $1.6 trillion, and getting rid of that burden on people would be an absolutely amazing thing that I am definitely in favor of, but I just don't know how we can afford to pay for it and kind of wipe it clean and then also make tuition free in the future, considering how much debt we already have. And when we include all types of debt, the US total debt is sitting at close to $74 trillion, with almost $20 trillion in personal debt and $15.6 trillion in mortgage debt. Needless to say, our huge debt levels could be a major drag on future growth, but it doesn't even stop here. It doesn't stop just at the federal and kind of consumer levels. It also extends out to corporate levels. So reason number 1 is going to be US corporate debt, and it's at some pretty scary levels. Now, throughout recent history, our interest rates have dramatically declined, and ever since the Great Recession, these rates have been artificially kept at the lowest levels in history for much of the past decade, with them only starting to climb again in the past few years. And these lower interest rates have encouraged US corporations to borrow more and more money, leading to record-breaking debt levels of almost $10 trillion. If we look at these numbers as a percentage of GDP, we can see that sharp peaks are oftentimes followed by a recession a short time after, which we're currently sort of experiencing right now. Now, a lot of this corporate debt has been used by companies to expand their businesses and fuel economic growth, but a ton of it has also been used to buy back their own stock and pay growing dividends, which can be absolutely great for investors, but it ultimately pumps up the stock market and can potentially create a bubble if you're not careful. Last year alone, we had the greatest number of share buybacks that we've ever seen in history. The reason why this is a problem is because interest rates can't stay artificially low forever. So as they go back up, corporations need to limit their borrowing and start getting rid of that excess debt that they've ballooned over the past decade. This means that they can't really afford to keep buying back stock and paying out huge dividends, so under the wrong circumstances, this could lower stock prices and potentially snowball into a market crash. Now, according to S&P Global, US corporate debt to cash wasn't all that bad at a ratio of only about 3 to 1 last year, but the problem is that most of that cash was held by only a handful of the biggest companies at the top. When looking at speculative grade borrowers in 2017, the ratio worsens to a ratio of around 8 to 1, or about a 12% ratio of cash to debt. For comparison, the same ratio was better even in 2008 when it was higher at 14%, and we all know that a recession followed soon after. To be fair, Fitch Ratings, which is one of the big three credit rating agencies, estimated in the second half of last year that new investment grade issuance was down 15%, while high yield issuance was down 32%, meaning less debt is being taken out, and thanks to the tax cuts, the top 100 corporate non-financial companies spent $72 billion of new cash flows to pay down their debts even further. Although, to kind of play devil's advocate, even more than that was spent on share buybacks and dividends instead at $81 billion. But Fitch also noted that companies are now spending more on debt reductions, and a big swing can be seen in companies shifting from being a net borrower of debt to now being a net payer of debt ever since the corporate tax cuts. Now, speaking of corporations, I just want to finish the video by citing a Duke survey that's been conducted every single quarter for the past 92 straight quarters, and I actually covered the previous quarter in one of my previous videos. So I want to give you guys an update on this latest quarter because they surveyed over 1,500 CFOs from around the world, and when looking at US CFOs, United States CFOs in particular, they are once again predicting that a recession will happen next year. In fact, 38% believe that it will start by the first quarter of 2020, while 67% think it'll happen by at least the third quarter of 2020, and as much as 84% think it'll start by the first quarter of 2021. So those are some pretty scary predictions to think about. In any case, these are some very real concerns that I think everyone should be aware of and should be paying attention to, but I don't think you should be losing sleep over it. At the end of the day, I'm a long-term investor. I focus on buying good companies at good valuations for the long term, and as long as I can get that, I'm more than willing to invest. Now, there are definitely times where valuations do get too expensive, and when that happens, I just keep funneling my monthly budget into my cash position. So currently, I have about 30% of my portfolio is in cash and is just kind of ready for me to deploy into stocks. But the reason I do that is because I'm still realistic. I focus on the long term and I don't lose sleep over what everybody else is saying. Everybody constantly is screaming about a market crash every single year. And if I listened to them, I would have never invested in stocks in the first place. So I ignore that. I focus on the fundamentals of my investing strategy, and I think long term. But I'm realistic. I know that we haven't had a market crash in a very long time. I know we're overdue. It's got to happen at some point. And when it does, I'll be ready. I have, again, 30%. It's a ton of my portfolio ready to be deployed into some great companies at incredibly cheap prices during the next market crash. But even if we just have a correction like what we saw at the end of 2018, when everybody was so sure that that was going to turn into a huge crash and nobody wanted to buy stocks at that time. By the way, this is a great point to bring up, which is that everybody that is always screaming about a market crash happening this year, next year, even when we have a correction or even a market crash, they're the last people that are willing to buy stocks. They keep thinking that everything can only get worse and worse and worse. They're never very, very optimistic. And for me, I'm someone who is optimistic about the US economy for the long term. So anytime that I see a correction, especially a market crash, I'm more than willing to start deploying my money into stocks. And I do it kind of slowly over time, gradually, because I do have time on my side. I'm not as young as a lot of you think I am based on the comments you guys leave. I'm definitely way older than some of you think I am, but I am still relatively young. I still have a relatively long time horizon, so I can play the long game and I can be patient. But anyway, I'm definitely rambling on, so I got to end the video. But thank you so much for watching. I hope you guys enjoyed the video. If you did, make sure you hit the like button. Leave your thoughts and comments down below. I'd love to read them and respond to them. And again, thank you so much for watching. I'll catch you guys in the next one. Take care. Bye-bye.